Prop firms market a specific dream, pay a small upfront evaluation fee to gain access to hundreds of thousands of dollars in trading capital. Internal data shows the difficulty of that first step. Only 14% pass the initial evaluation stage. Following the data reveals an even steeper drop. The percentage of users who actually reach a payout sits at 0.072%. The business model functions as a mathematical filter. By setting tight parameters for success, these firms eliminate nearly every participant before they ever withdraw a profit. Understanding the high failure rate requires looking at where the money goes when a user executes a trade. Prop firms operate in a simulated B-book environment. Trade orders are diverted from actual markets and recorded only on an internal ledger. With no money entering the real market, the firm's revenue relies entirely on a constant cycle of evaluation fees. The firm's profitability depends on these fees. This creates a financial incentive to maintain rules that keep users in a cycle of failing and retrying the evaluation. To manage the risk of payouts, firms implement specific trading rules that are difficult to sustain over time. This chart tracks the daily trailing drawdown. As profit reaches a new peak, your loss limit adjusts upward alongside it. If the market experiences a routine fluctuation and your profit dips slightly, it hits that rising limit, resulting in immediate account termination. These trailing limits function as mathematical tripwires. They narrow the margin for error until a violation becomes statistically likely for most traders. These rules exploit a biological trait called loss aversion. Humans tend to experience the distress of a loss about twice as intensely as the satisfaction of a gain. This intense emotional reaction triggers high stress, impairing the prefrontal cortex, the brain area responsible for logical decision-making and following a set trading plan. Traders often focus on their starting account balance as a mental anchor. Dipping below this number creates a sense of anxiety that the brain tries to resolve as quickly as possible. The result is revenge trading. Driven by the urge to recover the loss immediately, a trader often takes larger, riskier positions that ignore their original strategy. Blown accounts occur when these high-pressure rules meet these natural biological responses. The environment is structured in a way that favors impulsive errors over disciplined trading. Long-term retail traders often share warnings about these structural traps. Online communities are full of accounts from people who realize the difficulty of the prop firm model only after losing multiple evaluation fees. Because the accounts are simulated, firms retain total control over the capital. Some traders report that firms can use technicalities in the fine print to delay or refuse payouts when a user finally succeeds. Payouts to the small percentage of winners are typically covered by the evaluation fees of new participants. This creates a cycle where the losses of the many fund the withdrawals of the few. The industry relies on a constant stream of new users. The survival of the firm depends on a high volume of traders who pay for evaluations but never reach a payout. The illusion of access to large amounts of house money often encourages reckless behavior. It is easier to take extreme risks when the capital doesn't feel like personal, hard-earned cash. Trading your own capital naturally enforces a different kind of discipline. You define your own risk, work on your own timeline, answer to your financial reality rather than an artificial set of rules. Success in trading involves avoiding the engineered traps of the prop firm industry. True survival comes from the disciplined process of trading your own capital.